This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So, are you happy now with the basics of deferred tax? Did you manage to go through and complete that example and look at it for the third year? If you did, great. And if you went through right the way to the end of the sixth year, then even better. Well done. Hopefully, though, that means that you understand the 4 steps. So, working out the temporary difference, taking the temporary difference and multiplying it by the tax rate that we expect the asset or the liability to be settled at. Looking then at deciding whether it's a deferred tax asset or liability. That then gives you the SFP figure in step 3, and then step 4 is the movement, which then goes through to profit or loss, doesn't it? Okay, excellent. Let's move on and have a look at some other scenarios in the individual financial statements that give rise to deferred tax that you could previously have done at F7, but you tended not to see them at F7. It was just more PPE, wasn't it? So what we've got now are provisions. Provisions are governed by IAS 37. We recognise a provision in the financial statements, don't we? If we have a present obligation, so whether that's a legal or a constructive obligation as a result of a past event, probable outflow of economic benefit, and we can measure the benefit reliably, can't we? It's an educated guess, isn't it? A fairly well-educated guess based upon the rules that you have within the standard, based upon your best estimate of the expenditure. But the taxman doesn't like estimates and doesn't like guesses. So although we have our liability under IAS 37 as the carrying value, the tax base is nil. And the reason why the tax base would be nil is because the tax authorities would allow the expenditure on a cash basis. We're looking at the accounts and the carrying value on an accruals basis. Tax authorities in this instance prefer things on a cash basis. So therefore the tax base is always nil. Okay. The carrying value, we know what that is, and that will allow us a deduction in the future. So if we're looking at a deduction in the future, we are going to save tax in the future. So therefore we're looking at a deferred tax asset. So when you have your provisions will give rise to a deferred tax asset. And following our rules, we will generate a deferred tax asset if the carrying value is less than the tax base. So to ensure that the carrying value is less than the tax base, make sure there that you treat the liability as a liability and show it in brackets. Okay, if you show it in brackets, your negative figure is always going to be less than the tax base of 0, and therefore we have a deferred tax asset. Deferred tax asset, a tax deductible temporary difference, because when we pay the cash in the future, we will save tax. Okay, excellent. Intangibles, essentially intangibles focus on development costs. Research gets expensed, and the tax authorities allow that research as an expense in the year that it's incurred. So there's no difference whatsoever there. There will be a difference with regards to development costs, because again, the tax authorities allow development costs as a tax allowable deduction as they are incurred, because they want to encourage research and development, don't they? So the tax base is always nil. They don't recognize an asset within the financial statements. The carrying value is used under IAS 38, isn't it? So we look at our cost and we capitalize it, provided we meet the development criteria. Following that mnemonic was its sector. And then when the asset is ready for use, we will then begin to amortize it. So we have our cost less our accumulated amortization as our carrying value, which is always going to be then greater than the tax base, which is always going to be nil. So again, what we're going to have there, similar to PPE, is that we will have a deferred tax liability within the accounts. Okay. Do just be careful. We have a deferred tax liability every year, but what should happen is as that development cost is amortized further, the carrying value begins to decrease further. So therefore we have a reduction in the liability every single year. Okay, so when you have your deferred tax liability, that tends to go through and reduce each year if you just focus upon that little bit of development and don't include any other maybe recently capitalized development expenditure in the year. So your development costs tend to reduce each year. So what tends to happen there when you look at the movement is that you debit your deferred tax liability as you're reducing the liability, and you credit your tax expense in the statement of profit or loss, which ultimately means that you reduce the expense. So be very, very careful. Although it gives rise to a liability, it's a liability that reduces, and as the liability reduces, we have a reduction in the expense. Okay, excellent. Having said that, we very rarely see it within the exam, or at least we have as of yet. It could appear, you never know. The last one of the four, one that I just want to focus upon, I think there is an example below, is all about share-based payments. Share-based payments, we've gone through there and seen that we go through and look at the fair value at either the reporting date or at the grant date, depending upon if it is cash settled or equity settled, respectively. And the tax authorities will allow us a deduction, but they will allow us a deduction when the exercise or when the employees exercise those options. So it won't be until some point in the future that we get the deduction. So therefore, the tax authorities don't recognize anything within their tax accounts. So the tax base is zero. Okay. Once that tax base is zero, we then need to look at the carrying value. Now, the carrying value that we've looked at under IFRS is based upon the fair value of the option, isn't it? Or the fair value of that share-based payment. Just note, we've crossed it out there. We'll cross it out again. For the carrying value for deferred tax purposes, we don't use IFRS 2 because IFRS 2 uses all sorts of crazy models, whether it's Black-Scholes or some binomial option pricing model to work out the fair value. We don't like that too much. It's a bit too much of a very well-educated guess that you'd see from P4. So what we go through and do there is we use something that is a little bit more factual. And more factual is the intrinsic value of the option. I don't want to get too bogged down with what the intrinsic value actually is. It's essentially just the difference today of the value of the share compared to what you would pay for it. Okay. So if you had a share worth, say, £10 that you could buy, or $10, and that was the value of the share, and to get it you could pay $8 as part of the option, and the intrinsic value is the value that is the difference between the 8 and the 10. So the value that you get if you were to buy the option and immediately then sell the share, you would generate $2, and that is factual. Okay, you know how much you can pay to get the share, you know how much you can then sell it, and that is the intrinsic value. Okay, the fair value of the option is a little bit different because on top of the intrinsic value, we then need to consider the time value. And if you're really interested about intrinsic and time values and you are brilliant at F9, then I would recommend that you start thinking about P4 as one of your option papers. Don't listen to what people say about it. It's tough, but then all the option papers are tough. Okay, but aside from that, for the share-based payments, we use the intrinsic value. Okay, so let's go through and have a look at the example that you've got there. Is example number 2 on share-based payments. It says calculate the deferred tax balance to appear in the statement of financial position at the end of the year in relation to the share-based payment scheme. So when you're looking at the deferred tax balance as it is to do with a share-based payment scheme, the key thing that you need to look at there is the intrinsic value, isn't it? Okay, there we go. So it says Brown has granted 1,000 equity settled share-based payment to each of its 100 employees. The vesting period is 4 years and no employees are expected to leave over this period, keeping it nice and simple. Okay. The fair value of the option at the grant date. So for IFRS 2 purposes, we would use the grant date $2, but not for deferred tax purposes. For deferred tax, we use the intrinsic value at the end of the year, and that there is $1.60. So for deferred tax purposes, you've got 1,000 options, 100 employees. the $1.60 intrinsic value, and we're at the end of the first year out of 4, aren't we? Okay, so that goes through there and gives you, is it $40,000? That there, if you like, is your carrying value. The tax base we know is always nil, so your temporary difference is there, isn't it, as 40,000. Okay, if we follow on from the first example that the tax rate was there, was it at 20%, then what you've got there is at 20%. So if you like, that was step 1, this is step 2. At 20%, that's going to give you, is it 8,000? And then step 3, the carrying value is greater than the tax base, isn't it? It will always be the case. Careful, Christopher. Getting carried away there. The carrying value is going to be less than the tax base, because we're thinking of it there as a deduction, aren't we? Okay, it's equity because it's an equity settled share-based payment. That's, if you like, a negative asset, isn't it? Like a liability is the opposite of an asset. So what you've got there is you will have, is it a deferred tax asset equal to $8,000, isn't it? Okay, so that's what you would show in the SFP. The reason why it's an asset, forget about the carrying value being less than the tax base. Think about it logically. When these options are exercised by the employees in the future, you will be allowed the deduction, and therefore you will save tax in the future. And if you're saving tax, that's a benefit, isn't it? So things that are beneficial within the financial statements are referred to as assets, aren't they? Excellent. There we go. Just to go through and then carry on with the examples before we then go through and start to look at what happens with regards to losses and group accounts. There's an example there about the revaluation, and the revaluation of PPE. Again, I think you touched upon it in the days of F7, didn't we? And the key bit about the revaluation is that when you revalue the asset, you get a gain, don't we? And that gain goes through other comprehensive income. The issue that you have there with regards to deferred tax is that the tax authorities ignore that gain until it has actually been realised when we come to dispose of the asset. So therefore, what now happens is, following the gain and the revaluation, the carrying value is now much higher than where it was previously. The tax base is unadjusted because the tax authorities ignore the revaluation. So we get a much, much bigger deferred tax figure. Okay, so when we're looking at the movement in that deferred tax, not all of it is now going to go to profit or loss, because part of the movement in deferred tax is due to the gain, and the gain went to other comprehensive income. So any tax on that gain should also go to other comprehensive income as well, to be consistent, to match the tax expense to whereby it appears within your performance statement. Okay, so that's what we need to do. Okay, we need to try and incorporate that gain into our deferred tax, and then work out how much tax there will be on that gain in relation to other comprehensive income. So what we've got is, it says there, explain how the revaluation, including any tax impact, should be dealt with in Clark's financial statements for the year ended, is it the 31st of December 2015. And it says that Clark bought a property for $500,000 on the 1st of January 2015. So everything at the start of the year was zero. Okay, so the tax base was zero, and then what we did is we bought an item, a PPE, we capitalized it at cost plus our directly attributable costs, and then we depreciated it over its useful life from when the asset was ready for use, which presumably was there the 1st of January. Okay, so you can explain that if you so wish within the question, but I'm not focusing on that. I'm focusing more upon the revaluation aspect. The 31st of December, so that's the end of the year, the property had a carrying value of 480 and revalued, is it there, to 800,000. So based upon that, what you've got there is you're going to have a gain, isn't it, of 320,000, and that gain, ladies and gentlemen, goes to other comprehensive income, doesn't it? Okay, it's unrealized, so we dump it into that bit of a white elephant, which is there your other comprehensive income, which then feeds in to your other component of equity on the statement of financial position, doesn't it? Okay. We're then told the tax written down value was 420, and the tax rate is there at 20%. Now that's where the deferred tax starts to come in, because if we look at the carrying value now, it's 800,000, isn't it? Because the tax authorities are going to let you go through and perform whatever crazy accounting rules you have. They ignore it, so they leave their tax written down value at 420. They don't increase it up to the revalued amount, do they? So that therefore means that our value for deferred tax, our temporary difference, is much higher, isn't it? Because previously we would have been comparing the 420 to the 480, but now we're comparing 420 up to 800,000, aren't we? Okay, so let's just go through that and have a look at how it all goes through and works. So we're going through that. We're thinking about your revaluations, aren't we? Okay. So what we have there, step 1, carrying value versus tax base to give me my temporary difference. Okay. So we're going to work it as normal. Just go as we did before. So the carrying value at the end of the year after the revaluation is 800,000, isn't it? The tax base, if memory serves me right, was 420. So therefore that gives me a temporary difference is that of 380,000. Okay. Step 2, we're going to tax that. Is it at 20%? 380 times 20% is that there as 76,000. Step 3, carrying value is greater than the tax base, so you have a deferred tax liability equal to $76,000. So you can forget all this revaluation nonsense, proceed as normal. Obviously, take account of the revaluation in the carrying value, because that's what the asset is under IAS 16 in our books, and get the liability figure. The revaluation, we don't need to make any adjustments just yet on the SFP. The issue that you have, however, is the movement, isn't it? Because when we go through and look at the movement, that's where we need to be a bit careful. Because when we look at the movement previously just used to go to, was it the statement of profit or loss? However, now some of that movement is due to the gain. So that also needs to go to your other comprehensive income, doesn't it? Okay, and that's where the challenge lies. So what we've got when we're looking at the movement, we're going to go through and credit my deferred tax liability. Okay, was that there as 76,000. We're going to go through as well and debit other comprehensive income. I think it's always easier to work out what the tax is on the OCI, because what we've got there is we had a gain, was it, of 320,000. We tax that at 20%. Does that give me 64,000? So when I go through there and then balance it up, the balancing figure that you have is a debit. That debit goes to the statement of profit or loss, and that there I think is 12,000. Okay, there we go. That 12,000 is sometimes referred to as your normal movement, or if you like, the movement that there would have been before any revaluation took place. So if we play around with it and be very brave, I think what we had there, if we go back to the example, the carrying value was 480, wasn't it? So if we were to put in, you don't need to do this, it's just for demonstration purposes. If there was no revaluation, the normal movement would have been 480 to 420. That then means the carrying value is it greater by 60,000, and at 20% there, that would have given us 12,000. Okay, so that, if you like, is the normal movement, looking at the carrying value pre-revaluation, and the normal movement that we just worked out quite simply as a balancing figure. Look at the debit to OCI is at the 64, based upon, was it the gain, and multiplying that by 20%, and then the remainder goes to profit or loss. Okay, there you have it. That's it. Nothing else to go through there and consider. The last little bit that I'll do on this video, because I will go through and talk about groups separately, I'm still keeping it in the individual accounts here first, is looking at losses. Okay, if you have losses, the assumption is that those losses are going to be carried forward. If you are going to carry forward those losses, you can utilize them against future profits, which will reduce your future profits for tax purposes, and therefore you will pay less tax, won't we? Okay, if we're paying less tax, then therefore we are going to be saving tax in the future. So if you have your losses, then that will give rise to a deferred tax asset. Okay, that deferred tax asset is going to be equal to the losses that you have to carry forward, multiplied by the tax rate at which the losses will be settled at. Okay, however, do just be careful. You need to be prudent, don't we? It's not prudent to recognize an asset unless you are virtually certain that it will be utilized. So you need to make sure that there are future taxable profits available that you can offset those losses against. As well as them being future taxable profits, they need to be operating profits, and not, if you like, any other type of profits, whether that's capital profits, to go through and utilize those losses against. It has to be operating losses against operating profits. That's a really small part of deferred tax, but it's new, and these new things do tend to crop up. So do just be aware. It has cropped up. I think it was in a question too a good few years ago now, that there was a very small bit about your deferred tax and your losses, and whether or not a particular scenario was giving rise to you as a company being able to carry forward those losses and recognize that deferred tax asset. I think, if memory serves me right, there were not going to be the losses or the profits available in the future to utilize those losses against. So therefore, we were not able to recognize the deferred tax assets. There you go. That's everything to do with the individual company accounts. What I'd like you to do before I start talking about the groups, I know it's there ready to be spoken about, but I'd like you to go through, work everything through once again, make sure that you're happy with it before you rejoin us in the last video to go through there and have a look at deferred tax and how it arises within group accounts. So I'll see you all in a wee while.